Hey there, it's Casey at TaxSaleAcademy.com and welcome to this week's tax sale question. This is actually a question that I've been asked many times over the years and here recently both. But the question is, should I invest in tax liens or tax deeds? What should I invest in? This is going to be one of the first questions that you might even ask yourself when you get into this business. For a well-rounded portfolio, I suggest both. But starting out, it's going to depend on your objective, and you'll likely want to choose one or the other. So let's look at it a little bit deeper. First, we must understand the difference between the two. They both will start when the taxes on a piece of property go delinquent. So in other words, when the owner fails to pay the taxes on time. That's where the whole tax sale process begins. Now, since the county relies on these funds, they must take some sort of action, right? All these funds provide stuff that we take for granted, like roads, bridges, sidewalks, parks, first responders. So many things come out of our property taxes. So again, the county has to do something. There's a few different types of systems that are used, but we're going to compare the tax deed and tax lien systems in today's video to help answer this question. So a tax lien is a priority lien against a parcel of real estate. You are essentially paying the taxes for the owner. So in exchange, you're going to earn interest on that payment. Now, the interest rate can vary greatly from a negative rate to those who don't really know what they're doing to 25% or more if you're on the fortunate side. The large majority of these liens will get redeemed, which means the owner will come back, pay the back due taxes plus the interest and any fees, okay? So as the investor, when that happens, you will collect your initial investment plus your profit, which is the interest on that money. So say you invest $1,000 at 15% for 2 years, your $1,000 then suddenly turns into $1,300 if it takes 2 years for that owner to redeem. Pretty simple, pretty easy, right? Now, if the owner fails to redeem that property, then you have the ability to become the owner of that property. It could be through an actual foreclosure or just might be through submitting the appropriate paperwork depending on how your state handles it. So the large majority of the time with a tax lien, you're gonna make your money when you go and check your mailbox. You're gonna get a check for your initial investment plus your profit, which is your interest. On occasion, you will become the property owner, but that is more the exception than the rule. So as a tax deed investor, you're buying the actual property. In this situation, the county has a delinquent tax list. Now, likely they charge their own interest and that kind of stuff to the taxpayer, but that is on their side. But after a set period of time, the county says, listen, this person is not going to pay the late fees. They're not going to pay for this property. Let's foreclose on this property and we're going to auction it off. So that's a tax foreclosure, and then they sell it through a tax deed. So when you buy a tax deed, you're buying real estate. You're actually buying a piece of property and not just a lien. So obviously, you must know everything possible about that piece of property before you acquire it, right? So the only way to make money with a tax deed is to somehow utilize it, somehow make money off of it that's at your direction. You won't just go out and check the mailbox and get a check. You'll have to sell it, you have to rent it, you have to do something with it. You have to take some sort of additional action to make money once you buy that tax deed, okay? Now, the whole difference here comes after that purchase. If you remember right, a tax lien, your return will likely come without much effort at all. But with a tax deed, your return will likely come with more effort because you have to actually take action to sell it. So in short, here's kind of what I tell everybody when they ask me this question. When you're dealing with tax liens, you're usually going to have a lower return, but you're also going to have to invest much less work. When it comes to tax deeds, you're going to have a higher return, a higher margin, but it'll also require much more work. So tax liens, lower return, go to your mailbox, collect the check. Tax deeds, higher return, you have to put forth action to sell or otherwise use and profit from that property. Now, the fact of the matter is you should have both in your portfolio, but when you start out, you might want to choose one or the other based kind of on this video and what you think you'll be able to put into it as far as money and time both. So hopefully this helps you out. If you have a question about tax sale investing, feel free to leave it below this video or any other videos on my YouTube channel. I'd be more than happy to respond, and I might just record a video like this one. Hey, take care, folks. For more information on tax sale investing, check out TaxSaleAcademy.com. Bye-bye.